Preparing for a financial analyst at Dominion Energy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Dominion Energy? I am attracted to Dominion Energy because financial analysis directly supports essential infrastructure and customer service. The business requires disciplined forecasting, careful capital allocation, and clear communication around regulated investments and operating performance. My strengths in Excel, financial modeling, variance analysis, and presenting insights would help decision-makers understand trends and trade-offs. I also value the company's long-term perspective. Investments in reliability and cleaner energy must produce durable benefits while maintaining affordability and financial discipline. While answering, connect your analytical skills to Dominion Energy's regulated utility operations, capital-intensive investments, customer impact, and long-term financial planning. Demonstrate knowledge of reliability, affordability, energy transition, and the company's operating environment. Question 2. What do you know about Dominion Energy's business model? Dominion Energy primarily operates regulated electric and natural gas utilities, where rates are generally established through regulatory proceedings to recover prudent costs and provide an allowed return on invested capital. That model creates relatively visible cash flows, but performance still depends on demand, weather, operating efficiency, financing costs, and regulatory outcomes. The company is also managing substantial infrastructure and energy transition investments, so analysts must connect operational assumptions with rate base, earnings, cash flow, and customer affordability. Make sure to cover Dominion Energy's regulated utility focus, electricity and natural gas operations, rate base economics, capital investment requirements, customer demand, regulatory oversight, and the distinction between regulated and merchant business risks. Question 3. How would you build a financial forecast for a regulated utility? I would begin with historical revenue, expense, and cash flow trends, then forecast operational drivers rather than applying unsupported growth rates. Key assumptions would include customer count, usage, weather, approved tariffs, fuel costs, labor, maintenance, capital expenditures, depreciation, and financing needs. I would separately identify pass-through items and regulatory recovery assumptions. Finally, I would build base, upside, and downside cases, reconcile the forecast to prior periods, and clearly document every material assumption for review. In your answer, talk about customer growth, usage, tariffs, weather normalization, fuel costs, operating expenses, capital expenditures, depreciation, financing, regulatory recovery, and sensitivity analysis. Explain how you would reconcile the forecast to historical results. Question 4. Explain rate base and why it matters to Dominion Energy. Rate base is the amount of utility investment regulators generally allow a company to recover through customer rates and earn an approved return on. It commonly includes qualifying plant and equipment, adjusted for items such as accumulated depreciation and regulatory balances. For Dominion Energy, rate base growth can support future earnings and cash flow, but only when investments are necessary, prudent, and accepted by regulators. Therefore, analyzing capital plans requires understanding both project economics and recovery timing. Be sure to mention the regulated asset base, prudently incurred capital, depreciation, accumulated depreciation, allowed return, regulatory approval, and how rate base supports earnings and customer rates over time. Question 5. What is the difference between revenue, net income, and operating cash flow? Revenue represents sales earned from customers, while net income is the accounting profit after operating costs, interest, taxes, depreciation, and other items. Operating cash flow measures cash generated by core operations and adjusts net income for non-cash expenses and working capital movements. For example, depreciation reduces net income but not current period cash. In a utility, I would analyze all three because earnings, liquidity, and the ability to fund capital investment can move differently. Focus on revenue as earned sales, Net income is profit after expenses and non-cash items, and operating cash flow is cash generated by operations. Include working capital, depreciation, accruals, and why cash conversion matters. Question 6. How would you analyze a variance between actual and budgeted operating expenses? I would first quantify the variance and rank it by materiality, then separate timing, volume, price, mix, and one-time effects. I would compare actual results with both budget and prior year, investigate unusual movements with the responsible team, and determine whether the variance is controllable or operationally driven. A favorable result is not automatically sustainable. For example, delayed maintenance may improve current expenses but create future risk. I would document the cause and update the outlook appropriately. Make sure to cover materiality, price volume mix effects, timing, weather, one-time items, controllability, root cause analysis, forecast updates, and communication with budget owners. Distinguish favorable from sustainable variances. Question 7. How do interest rates affect a utility such as Dominion Energy? Higher interest rates increase borrowing costs, reduce the present value of future cash flows, and can pressure project economics and equity valuation. They matter particularly for Dominion Energy because utilities require substantial capital and regularly refinance debt. I would assess maturities, fixed versus floating exposure, interest rate assumptions, and the timing of regulatory recovery. Higher rates may also affect customer affordability and permitted returns, so I would model both financing impacts and potential changes in investment or construction timing. In your answer, discuss debt refinancing, interest expense, valuation, customer rate affordability, weighted average cost of capital, capital-intensive projects, and the possible lag between financing costs and regulatory recovery. Question 8. What financial metrics would you monitor for Dominion Energy? I would monitor earnings per share, operating cash flow, capital expenditures, free cash flow, adjusted operating performance, debt to capital, interest coverage, and liquidity. For a regulated utility, I would also track rate base growth, customer growth, weather-normalized demand, regulatory recovery, and reliability indicators. These measures are interconnected. Aggressive capital spending may increase future rate base but reduce near-term free cash flow, while leverage affects financing flexibility. I would evaluate trends against budget, guidance, peers, and covenant requirements. Mention earnings, operating cash flow, free cash flow, capital expenditures, rate base growth, debt ratios, interest coverage, customer growth, reliability measures, regulatory outcomes, and variance to guidance. Explain why metrics should be viewed together. Question 9. How would you evaluate a proposed capital project? I would evaluate the project's purpose first: reliability, safety, compliance, customer growth, replacement, or energy transition. Then I would test construction cost, schedule, operating savings, useful life, depreciation, financing, and the likelihood of regulatory recovery. I would calculate NPV and IRR where appropriate, but I would not rely on those metrics alone because regulated projects can create value through approved rate-based treatment and avoided risks. Sensitivity analysis would show exposure to delays, inflation, and cost overruns. Focus on strategic necessity, reliability, safety, regulatory recovery, construction cost, schedule, operating benefits, NPV, IRR, sensitivity analysis, financing, and customer impact. Note that a regulated project's value extends beyond standalone commercial returns. Question 10. What is free cash flow, and why can it be negative for a utility? Free cash flow is commonly operating cash flow minus capital expenditures. A utility may report negative free cash flow while operating normally because infrastructure investment can be very large and occur before related customer rate recovery or cash benefits. I would investigate whether spending supports approved, recoverable projects, whether operating cash flow is stable, and how the GAAP is financed. I would also assess leverage, liquidity, dividends, and future recovery rather than judging the company from one period alone. Explain free cash flow as operating cash flow less capital expenditures, then discuss infrastructure intensity, construction timing, regulatory recovery, dividends, financing, and why negative free cash flow does not automatically indicate poor operations. Question 11. How would you model electricity or natural gas demand? I would forecast demand using customer growth and usage per customer, with separate assumptions for residential, commercial, and industrial segments. Weather normalization is essential because heating and cooling demand can materially distort historical comparisons. I would also consider economic activity, energy efficiency, distributed generation, electrification, and seasonality. After building the model, I would compare forecasts with historical relationships, management guidance, and external industry data, then create scenarios for unusually warm or cold weather and changing customer behavior. Be sure to mention customer counts, usage per customer, weather, seasonality, economic activity, industrial load, efficiency, distributed generation, historical normalization, and scenario analysis. Explain how you would validate assumptions. Question 12. How do you use Excel in financial analysis? I use Excel to organize source data, build driver-based forecasts, analyze variances, and present decision-ready outputs. I am comfortable with pivot tables, XLOOKUP, SUMIFs, index match, charts, conditional formatting, and sensitivity tables. I separate inputs, calculations, and outputs, use consistent formulas, and include checks for balance, completeness, and unexpected changes. Before sharing a model, I reconcile key totals to source reports, test extreme assumptions, and make the logic easy for another analyst to audit. Discuss structured models, formulas, pivot tables, lookups, data validation, error checks, scenario controls, reconciliation, and clear formatting. Emphasize auditability and explain how you prevent formula and input errors. Question 13. Describe a time you found an error in a financial model or report. In a budgeting project, I noticed that a monthly expense trend did not reconcile to the annual total. I traced the issue to a copied formula that omitted one department in several months. I corrected the formula, recalculated the forecast, quantified the impact, and informed the project lead before the report was distributed. I then added a department-level reconciliation and locked the formula range. That experience reinforced that automated checks and independent review are essential, even for simple models. In your answer, explain the control or review step that exposed the error, the financial impact, your root cause investigation, corrective action, communication, and the process improvement that prevented recurrence. Question 14. How would you explain a complex financial result to a non-finance manager? I would start with the conclusion in one sentence, then explain the 2 or 3 largest drivers using business language rather than accounting terminology. For example, I might say expenses were $4 million above budget primarily because storm restoration required additional contractor labor and materials. I would distinguish one-time from recurring effects, show the impact on the forecast, and recommend an action. I would keep supporting detail available but avoid overwhelming the manager with unnecessary model mechanics. Focus on leading with the conclusion, using plain language, quantifying the main drivers, separating facts from assumptions, tailoring detail to the audience, and ending with implications or recommended actions. Question 15. What is the difference between generally accepted accounting principles earnings and adjusted earnings? Generally accepted accounting principles earnings follow standardized accounting rules and include all recognized revenues, expenses, gains, and losses. Adjusted earnings typically exclude items management considers unusual, non-recurring, or less representative of ongoing operations, such as certain storm costs, impairments, or transaction effects. I would always review the reconciliation and question whether exclusions are genuinely unusual. Adjusted measures can improve trend analysis, but generally accepted accounting principles results remain essential for understanding reported performance, balance sheet effects, and comparability across periods. Mention generally accepted accounting principles as standardized reported accounting, adjusted earnings as management-defined exclusions, recurring versus unusual items, comparability, reconciliation, and the need to avoid treating adjusted measures as a replacement for audited results. Question 16. How would you analyze Dominion Energy's debt and liquidity position? I would review total debt, maturity dates, interest rates, fixed versus floating exposure, secured debt, liquidity facilities, cash balances, and covenant headroom. I would compare scheduled maturities and planned capital spending with expected operating cash flow and available financing. I would also monitor leverage, interest coverage, credit ratings, and market access. The key question is not simply how much debt exists, but whether the company can refinance and fund necessary infrastructure without creating excessive interest burden or financial flexibility risk. Cover maturity schedule, fixed and floating debt, interest expense, cash balances, revolver capacity, operating cash flow, credit ratings, leverage, covenants, refinancing risk, and upcoming capital requirements. Question 17. What role does regulatory approval play in utility financial analysis? Regulatory approval determines which costs can be recovered from customers, over what period, and with what return. I would analyze rate case filings, approved versus requested investments, allowed returns, recovery timing, and the treatment of regulatory assets or liabilities. A project may be strategically important but still face disallowance or delayed recovery if regulators question prudence or affordability. Therefore, I would incorporate regulatory outcomes into revenue, earnings, cash flow, and capital spending scenarios rather than treating them as background information. Be sure to discuss rate cases, prudence review, allowed returns, recovery timing, regulatory assets and liabilities, disallowance risk, and how regulatory decisions affect revenue, earnings, cash flow, and capital planning. Question 18. How would you assess the financial impact of a major storm or outage? I would estimate immediate restoration labor, materials, contractor costs, emergency procurement, asset damage, and any lost revenue. I would then identify insurance recoveries, potential regulatory treatment, and the timing of cash payments and reimbursement. Operational reliability and customer safety would remain the priority, but financially I would separate one-time storm effects from normal maintenance and update earnings, cash flow, and liquidity forecasts. Because uncertainty can be high, I would provide a range of outcomes with explicit assumptions. Discuss restoration costs, lost revenue, insurance, customer impact, capital damage, regulatory recovery, timing, one-time versus recurring effects, cash needs, and communication of uncertainty in the forecast. Question 19. How can energy transition investments affect Dominion Energy's financial statements? Energy transition investments can increase capital expenditures and construction work in progress before producing revenue or regulatory recovery. Once placed in service, they may expand rate base and create depreciation and operating costs, while tax incentives or approved cost recovery can improve economics. I would model timing carefully because cash outflows, earnings effects, and customer rate recovery may occur in different periods. I would also test risks involving permitting, construction costs, technology performance, asset retirement, and potential impairment. Mention construction spending, rate base, depreciation, operating costs, tax credits, financing, regulatory recovery, asset retirement, impairment risk, and timing differences between investment, capitalization, revenue recovery, and cash flow. Question 20. What accounting concepts are especially important for a utility financial analyst? I would pay particular attention to property, plant, and equipment, construction work in progress, depreciation, regulatory assets and liabilities, asset retirement obligations, leases, and impairment. Capitalization policy matters because costs placed into plant affect future depreciation and rate recovery, while expensed costs affect current earnings. I would also understand how regulatory accounting can defer certain costs or benefits. These concepts help me connect accounting results with project status, approved recovery, cash flow, and operational decisions. Focus on property, plant and equipment, depreciation, construction work in progress, regulatory assets and liabilities, asset retirement obligations, impairment, revenue recognition, leases, and capitalization policies. Question 21. Tell me about a time you worked with incomplete or inconsistent data. When source data is incomplete, I first define the decision the analysis must support and identify which gaps could materially change the conclusion. I reconcile available reports, investigate inconsistent definitions, and use a clearly documented assumption only when necessary. I also create low, base, and high cases and perform reasonableness checks against historical results. Most importantly, I communicate limitations early instead of presenting an estimate with false precision. That approach protects both decision quality and stakeholder trust. In your answer, cover how you assessed data quality, identified missing fields, reconciled competing sources, documented assumptions, used reasonableness checks, and communicated limitations before making a recommendation. Question 22. How would you prioritize competing requests from multiple stakeholders? I would rank requests by deadline, business impact, regulatory importance, dependencies, and effort required. I would clarify the exact decision each request supports, identify quick wins, and communicate a realistic delivery sequence to stakeholders. If two priorities conflict, I would escalate with options rather than silently miss a deadline. I would maintain a task tracker, provide interim outputs when useful, and protect review time for high-risk analysis. Responsiveness matters, but reliable and accurate results matter more. Mention urgency, decision impact, regulatory or reporting deadlines, dependencies, effort, stakeholder communication, task tracking, and renegotiating timelines when necessary. Show that you balance responsiveness with analytical quality. Question 23. What would you do if your analysis conflicted with management's expectations? I would first recheck the data, formulas, definitions, and period comparisons to ensure the disagreement is not caused by a technical error. Then I would discuss the assumptions with management and explain the result using a concise bridge from the prior forecast. If uncertainty exists, I would present sensitivities and identify which assumptions drive the difference. I would remain open to business context that the model misses, but I would not change a conclusion merely to match an expected answer. Be sure to mention validating data and formulas, checking definitions, discussing assumptions respectfully, presenting evidence and sensitivities, distinguishing facts from judgment, and remaining open to correction without compromising analytical integrity. Question 24. How would you evaluate whether a project is on budget and on schedule? I would compare actual and committed costs with the approved budget, then calculate the estimate at completion and remaining contingency. For schedule, I would track milestone completion, construction progress, procurement status, critical path activities, and expected in-service date. I would investigate change orders, labor or material inflation, permitting issues, and contractor performance. The important output is not merely a variance, it is the likely final cost, timing of rate recovery, cash flow impact, and required management action. Discuss approved baseline, actual and committed costs, forecast at completion, milestones, earned progress, contingency, change orders, procurement, critical path, variance explanations, and escalation thresholds. Question 25. What questions would you ask your interviewer at the end of a Dominion Energy Financial Analyst interview? I would ask which decisions this role most directly supports, what the team considers its most important forecasting or reporting challenge, and which metrics receive the greatest management attention. I would also ask how finance partners with operations, regulatory affairs, and project teams, and what distinguishes a successful analyst after 12 months. Finally, I would ask about training, feedback, and opportunities to improve models or processes. Those questions show preparation while helping me understand the role's actual priorities. Focus on questions about team priorities, forecasting cycles, key performance indicators, interaction with operations and regulatory teams, development opportunities, current analytical challenges, and how success is measured during the first year. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.